Welcome to the deep dive. Get ready to unpack something massive that's quietly reshaping the global financial landscape. Tokenization, and specifically how the world's largest asset manager, BlackRock, is diving headfirst into it.
Yeah, absolutely. We've got a really detailed report here, and it lays out exactly what BlackRock is doing, why it matters, and, well, what this means not just for markets, but potentially for you if you work in or follow finance.
Right. Our mission today is really to cut through the noise. This isn't just, technical jargon. It's about a potential architectural shift in how we own, trade, and interact with assets.
hmm
We're pulling out the key insights from this material to understand why this is happening now and, frankly, where it might be going. So let's unpack this.
Okay, so the first thing that really jumps out from this source material is that BlackRock isn't just playing around with blockchain because it's like the trendy thing to do.
No, definitely not.
There's a deep strategic logic driving their move into tokenization.
Right, it's very deliberate. And the big headline motivation seems to be efficiency and, well, slashing costs. Think about all those layers of middlemen in traditional finance.
Custodians, transfer agents.
Exactly. All that paperwork, the manual processing. The sources make it pretty clear BlackRock sees tokenization as a way to just sort of melt those away.
Yeah, automate things like clearing, settlement, even compliance.
Yeah.
Right into the digital asset itself.
Less friction, faster movement of value. It
Yeah.
makes sense.
And what's also fascinating is this potential for truly global 2047 liquidity.
hmm
I mean, imagine assets that can trade around the clock across borders.
Without worrying about market opening hours or different time zones, that's a huge shift.
It really is.
And access this seems huge too, right? For investors and for the assets themselves. The report highlights fractionalization.
hmm
So taking something really high value like expensive real estate or a slice of private equity,
Stuff most people can't normally touch.
right, and breaking it down into smaller, affordable digital pieces,
Yeah.
fractional shares essentially.
So suddenly, investors who are locked out, maybe retail folks, maybe smaller global players, they can potentially get access.
It democratizes it in a way.
Yeah, potentially. And it's also clearly a move towards future-proofing as finance evolves towards, programmable money and these concepts from DeFi, Web3 finance.
BlackRock wants to be ready. They're positioning themselves to be compatible with whatever that future plumbing of the financial system looks like.
Exactly. And they really see themselves as this crucial institutional on-ramp, creating regulated on-chain products.
Like tokenized funds.
Right. They're building a compliant bridge, a pathway for the big traditional players, pension funds, endowments, corporations, to step into the blockchain world confidently.
Making it safe and familiar for the giant.
That seems to be the play. So given those powerful motivations, what have they actually done? The report details some concrete steps they've taken.
Yeah, the most significant action highlighted is the launch of their BUIDL tokenized fund. That was back in March 2024. So this isn't theoretical, it's live.
It's live.
Yeah.
And it's built on the Ethereum blockchain, which is, a major platform in this space. And they partnered with a company called Securitize to make it happen.
Okay, and the asset underneath the token.
U.S. Treasuries and repo agreements.
Mm,
So very traditional, very low-risk assets.
got it. So what makes BUIDL interesting according to the sources? How does it work on chain?
Well, it offers real-world yield tied directly to those T-bills,
Right.
and that yield actually accrues daily. Investors can also redeem monthly.
And it sounds like it's really designed with institutions in mind.
Oh, absolutely. High-level security, full regulatory compliance, KYC, AML onboarding, all that. They position it as ideal for things like managing crypto treasuries, maybe DAOs, digital family offices.
Interesting target market.
Yeah. And that partnership with Securitize is particularly telling. The report notes BlackRock didn't just pick them as the service provider. They actually led a pretty significant $47 million funding round in Securitize earlier this year.
Oh, wow. Okay, so this isn't just a standard vendor relationship then. That investment signals something deeper.
Exactly. The sources suggest Securitize specializes in issuing tokenized securities. So by investing, BlackRock seems to be aiming for vertical integration.
They want the ability to both issue these tokenized assets and manage them, all under a regulated umbrella.
That seems to be the goal. It's about having control over the entire process, from creation right through to management.
Which leads us nicely into the potential financial implications of all this. What could this transformation actually mean for the markets and how value moves?
Well, a key point is the expansion and maybe transformation of existing asset classes. Tokenization can remove some really stubborn traditional barriers.
Like for U.S. Treasuries, for instance.
Yeah, it could potentially eliminate those large minimum purchase sizes, settlement delays. You could get real-time settlement and programmable access.
And for things like private equity, which are famously illiquid and hard to get into.
Tokenization could address that through fractional ownership, like we mentioned, and maybe even enable secondary trading markets where they don't really exist now.
And real estate. You could tackle the high entry costs, the long transaction times.
Imagine micro-investments in property, maybe something closer to 2047 trading. Even alternatives like infrastructure or farmland, which are usually pretty opaque,
Right, with manual reporting.
could potentially benefit from having transparent on-chain data streams.
Okay, but maybe the most compelling thing from these sources is the sheer scale of the potential market growth. Where are we now versus where could we be?
Right, so the current market for these tokenized real-world assets, RWAs, it's still relatively small, maybe around $6 billion in 2024, and tokenized treasuries are already a decent chunk of that, over $1.5 billion.
Okay, $6 billion sounds modest in the grand scheme, but the projections forward are, well, they're kind of staggering.
They really are. Estimates from major firms like BCG and McKinsey are suggesting we could see $10 trillion in tokenized assets by 2030.
$10 trillion.
And the World Economic Forum goes even further. They predict that by 2030, or maybe 2035, up to 10% of global GDP could be stored and transacted via blockchain tokenization.
Whoa. Okay, hold on. 10% of global GDP. Let's unpack what the report suggests that actually means. If global GDP is, I don't know, $130 trillion by then.
Having $13 trillion on-chain isn't just a number. The report describes it as an architectural transformation of capital markets.
So a really fundamental shift.
Yeah, it implies a significant move towards a more, maybe, decentralized financial system where major players, governments, corporations, individuals could transact directly, using digital wallets, automated rules embedded in the assets.
They talk about programmable economy.
Exactly, where things like compliance checks, taxation, yield distribution could happen automatically via the tokens themselves. It's a basic shift in how value moves and how it's controlled.
So it's not just innovation, it's potential re-architecture.
That's the idea. And that $10 trillion forecast for 2030 isn't just one big number. The sources break it down, showing how broad this impact could be.
Right. They see bonds, government, and corporate making up the biggest slice, maybe $3–4 trillion.
Real estate projected at $1.52 trillion, private equity and VC around $1.5 trillion.
And they also include equities, carbon credits, ESG assets, even art and collectibles.
Plus, a big chunk, $1–2 trillion, for other alternatives like infrastructure and royalties. So it's really touching almost every corner of finance.
Okay, so that's the potential market size, huge potential. But how does BlackRock, as an asset manager, plan to actually make money in this new tokenized world? The report outlines a few ways.
Well, first, they'll continue to charge their standard assets under management fees, AUM fees, just on digital assets now, maybe more efficiently.
Makes sense. Keep the core model.
Yeah, but they can also leverage the programmability of these assets. Their tokenized funds could be designed to generate yield on-chain or be used directly as collateral in compliant DeFi applications.
Creating new lending and yield opportunities for them and their clients.
Right, and importantly, that investment in securitized we talked about, it isn't just passive. It gives them a stake in the underlying platform.
Ah, so they can potentially earn revenue from transaction fees, issuance fees, on the platform itself.
Exactly. Capturing value across the whole life cycle of the tokenized asset. It's quite strategic.
No, BlackRock is obviously huge, but they aren't the only ones exploring this space, right? The report mentions others.
That's true, yeah. We see names like Franklin Templeton. They have their BNJ tokenized money market fund on Stellar and Polygon. That seems aimed more at crypto-native investors looking for traditional yield.
Okay. And Wisdom Tree.
They're active too, building out a blockchain-native investment ecosystem. Tokenized ETFs, yield products accessible through their own app, Wisdom Tree Prime.
Fidelity's in the business too, but maybe more quietly.
Yeah, exploring digital assets and tokenization through private initiatives, it sounds like, more internal research and getting ready. And even private equity giants like KKR have tokenized a portion of a fund on Avalanche to try and increase access.
So the field isn't empty. But what gives BlackRock that unique edge, according to this material? What sets them apart?
Well, their sheer size and global reputation are just unparalleled. The report really emphasizes they have the capacity to drive institutional adoption at a scale few others can match.
When BlackRock moves, the market really does pay attention.
Definitely. And crucially, they have those deep, established relationships with central banks, regulators, players across traditional capital markets. Navigating the regulatory side is absolutely critical here,
And their existing ties give them a huge advantage there.
a significant one. Plus, back to the securitized investment, that ownership stake gives them control.
Control over issuance, compliance, the investor experience, end to end.
Right. That integrated approach seems to be a key differentiator mentioned in the report.
Okay, looking ahead then, what are the broader strategic implications here? What does this tokenization trend mean for the entire financial industry?
The report suggests a pretty fundamental evolution in the role of asset managers. They might become more like platform operators,
Platform operators, what does that mean exactly?
firms that issue, distribute, and enable trading of assets directly on these programmable blockchains. The line between traditional finance and fintech is blurring a lot.
So firms like BlackRock could start to look and behave more like sophisticated software platforms.
That's the implication. And tokenization itself could become a foundational layer, like core plumbing for finance. The report uses the analogy of the TCP/IP layer of finance.
Like the basic protocol for the internet, but for assets. How they're created, transferred, made compliant.
Exactly. And there's potential for major synergy with other digital finance initiatives. Like, the report raises the possibility of central bank digital currencies, CBDCs, if they emerge.
Interacting seamlessly on-chain with tokenized treasuries.
Yeah, now imagine that. It could completely change how liquidity flows globally.
What seems really clear from the sources, though, is BlackRock's approach. It's very much regulatory first.
Absolutely. They're not building out in the sort of DeFi Wild West.
Yeah.
They're using regulated platforms like Securitize, working within existing frameworks.
The goal is institutional scale adoption, not just short-term experimentation, bringing blockchain benefits to mainstream regulated finance.
Precisely. Now, it's important we acknowledge this transformation isn't going to be perfectly smooth sailing. The sources outline some significant risks and challenges.
Yeah, what are the main hurdles?
Well, a major one is regulatory uncertainty. Digital asset rules vary so much globally. Inconsistencies could really limit how broadly and smoothly this can scale internationally.
That makes sense. Different rules everywhere makes it complex.
And there's also the risk of liquidity fragmentation. If you have assets tokenized on lots of different disconnected blockchains or platforms.
You might end up with isolated pools of capital, less liquid than one big market.
Exactly. Instead of unifying liquidity, you can accidentally split it up.
And cybersecurity and custody must be huge concerns too.
Paramount. You're embedding potentially vast amounts of value into code. So risks like smart contract bugs, securing digital wallets, ensuring institutional-grade custody solutions are absolutely robust. These are critical.
Definitely need to get that right.
And finally, there's just the market adoption lag. The tech might be efficient, but it requires new infrastructure, new ways of thinking, a lot of investment.
Many traditional institutions just aren't fully geared up for a blockchain-native world yet.
Not yet. Which brings us to maybe the most personal implication.
Yeah.
How does this affect the people working in finance? What skills will be needed? The sources have some interesting thoughts here.
Yeah, they suggest traditional roles will definitely evolve. Like a fund administrator might become an on-chain asset operator.
Or a debt syndicator becomes a digital bond issuance manager. It cuts across the board: private equity, operations, compliance. Roles will need new skills.
A compliance officer might need to understand how to audit smart contracts, for example.
Precisely. So what kind of new skills are we talking about? The report highlights a mix. First, understanding the text logic, smart contract literacy, grasping how these automated contracts work for payments, redemptions, etc., even if you aren't coding yourself.
So understanding the how.
Yeah. Then there's tokenomics and on-chain finance, understanding how the design and flow of digital assets impacts their value and interaction on different blockchains.
How the system actually works financially.
Right. Another key area is compliance tech, reg tech. Knowing how to use platforms that embed rules, like KYCML, directly into the asset itself, ensuring compliance automatically.
That sounds crucial for the institutional adoption piece.
Definitely. You also need proficiency with blockchain workflows, the practical side. Managing wallets securely, initiating issuance, tracking assets on block explorers.
The day-to-day interaction.
And finally, on-chain analytics, being able to analyze asset flows, risks, liquidity directly from the blockchain data.
Using that transparency. So who thrives in this new world?
The sources paint a picture of two main types. finance pros who learn these tech skills, becoming sort of quasi-techies.
Or tech pros who gain fluency in finance and can translate financial concepts into code.
Exactly. Hybrid roles are expected to dominate. You'll see CFOs and portfolio managers working really closely with engineers, smart contract auditors.
The report says by 2030, a finance team might look more like a fintech squad. Half coders, half capital allocators.
That's the provocative idea. For anyone listening who's in finance and wondering how to prepare, the sources offer practical advice. Upskill. Learn the basics: token issuance, stablecoins, maybe high-level coding concepts.
Look into certifications or training programs focused on blockchain for finance.
Yeah. And if possible, get involved in pilots using enterprise tokenization platforms. The report mentioned BlackRock's BUIDL, but also JPM's Onyx as examples of real-world systems.
Get hands-on experience.
And crucially, understand the risks. Things like dependencies on external data feeds, oracles, protocol risks, smart contract exploits. It's not just about opportunity, it's about managing new types of risk.
Okay, so that was quite a deep dive into BlackRock's significant moves into tokenization, all drawing from this comprehensive report.
Yeah, we started with why they're doing it. Those drivers of efficiency, access, future-proofing. Then we looked at what they're actually doing, launching BUIDL, investing in Securitize.
We explored the potential financial impact, transforming asset classes, those huge market size projections like 10% of global GDP potentially on-chain,
Yeah.
and how BlackRock plans to make money from it.
We compared their position to others, saw their unique edge from scale, relationships, that integrated approach.
And we covered the broader strategic implications: asset managers becoming platform operators, tokenization as maybe core financial infrastructure, and importantly, how this changes the skills you might need in finance.
And of course, we hit on those essential risks and challenges that still need careful navigation.
So reflecting on all this, what stands out most to you listening? Is it just the sheer audacity of the scale, that $10 trillion by 2030 number? Is it the revolutionary idea of programmable money with built-in compliance? Or maybe it's more personal, how your own professional skill set might need to adapt.
And here's maybe the really interesting question to leave you with. BlackRock's strategy is clearly about bringing tokenization into the regulated traditional system. Does this mean the future of tokenized assets will mostly evolve within those established walls?
Or will the original, more decentralized vision of blockchain continue to drive significant innovation and activity outside of these big institutional players? Where does the balance ultimately lie?
Something to definitely think about as you watch this space continue to unfold at, well, breakneck speed.